This is Jonathan Lopez with The Intelligent Investor. We are doing a homework tutorial on how to use the expected return calculator, and this is for Intelligent Investor Part 2, homework number 2. So what we want to do is we want to determine what our expected return would be if our estimates were to be correct. So let's work with CVS, which is one of the companies for our homework. So I'm going to put in here CVS, which is the company name. CVS also happens to be the symbol. We bought this company on 7/26 for $93.85. Okay, and how do I know that? Because here on our performance, we bought CVS for $93.85. I know this was on July 26th. So one other thing we need to know is what is their current dividend. You can find this on Yahoo. If we go up to summary and then we scroll down here to dividend, it says the current dividend is $1.70. Not the percentage, the dollar amount. $1.70 is the one we need. So let's go back to our spreadsheet and put $1.70. Okay, so those are the facts. Now here on this side we're going to put our 4 estimates. From homework number 1 we estimated earnings and the PE ratio. So for CVS we estimated earnings at 550 and a PE of 18. That was our earnings estimate, 550, PE ratio of 18. Okay, so let's put that on our spreadsheet. 550 and 18. So we estimate the value of the company to be $99. Now for homework number 2, our job was to estimate an earnings growth and then also estimate a dividend growth rate. Okay, so I won't belabor this too much because that's really the homework. And here's just where we put our results. So, but a couple quick ways to do this is on Yahoo Finance. If we go look at what the analysts are thinking, so there's 25 analysts, and what they're telling us is in the last 5 years, earnings have grown at 16%. They're expecting in the next 5 years 14%. So those are pretty good data points. On Guru Focus, if we look at their earnings, a couple ways we could look at this. 15-year financials, the earnings per share, they're saying, oh, without NRI, earnings have grown at 13.9% in the last 5 years and 11.5% over the last 10 years, over the last full cycle. So we want to be probably somewhere between 11.5 and 15 for our earnings estimate. Let's just say 12 to be somewhat conservative. Okay, so then we want to estimate the dividend growth rate. If we go back to Guru Finance, look at their dividends, and we see that over the last 5 years they've grown their dividend at 31%. Over the last 10 years, 26%. Over the last 3 years, 29%, and last year, 24%. So phenomenal rate of growth of their dividend. If we look at that, we'd probably use a number at least 20%, even being conservative. But there's another way we could estimate the dividend growth rate. That's using our sustainable dividend growth rate formula, which is the return on equity, ROE, times 1 minus the dividend payout ratio, which is 36%. So their return on equity for this company is 13.18. So if I take 13.18 times 1 minus 0.36, that gives me 8.43%. So sustainable dividend growth rate is 8.43. Historically, their dividend growth rate has been north of 20. So I just need to estimate what I think the dividend growth will be going forward. Let's say I'm conservative and I say 10%. Okay, so what that tells me is if I expect earnings to be 550 and I expect earnings to grow at 12%, that would tell me that next year I would expect earnings to be 616, and in 2 years 690, 3 years 773, 865, and 969 in 5 years. If it's trading at 18 times, I would expect this stock that I bought at 93.85 next year to be at a value of $1.10. Price may be above that, but that's how I expect the value to be, and growing over the next 5 years to $174.47. I also expect this dividend of $170 to grow at 10% a year. So I expect it to be next year $187 and growing over the next 5 years to $274. So if my expectations are true, here's what I would make. If I bought the stock for $93.85, first year I get dividends of $187, second year $206, third year $226, fourth year $249, and the fifth year I got a dividend of $274. Plus, let's say I sell it for $174. I have a positive cash back of 177.21. So that IRR on that 93.85 investment with these cash flows would be 15.09%. That's what I would expect if these estimations were true. So if I'm happy with 1509, maybe I'd buy that. And then what I would do is over the next 5 years, I would see if my expectations were right. If indeed it's earning $6.16 or roughly $1.54 a quarter, then I'd probably just hold on to it because it seems like, it's doing what I would expect it to do. If, on the other hand, they start missing earnings really bad and give guidance that they're not going to be able to do what I expected them, then maybe I would sell it. So that's a quick tutorial on how to use the expected return calculator and how to fill it in.